So, good afternoon, everyone. I'm Alison, and I am delighted to be your host and your chair for this afternoon's session. Before we start, just kind of a little word. I'm delighted to be hosting on behalf of the department, the Economic History Department, but also on behalf of the Economic History Advisory Board. And I'm delighted to let you know that I'm a member of that board, and I was also an alumni of the department. I graduated in 1990. It seems much more recent, but it was a long time ago. Just in terms of the board, I mean, one of the things that we are delighted to be able to do is actually to host events like this. And, you know, today I'm really pleased to have with us Simon Brewer. Simon is also an alumni of the department and a great friend of the LSE and of economic history. Not only that, he is the founder and CEO of Vantage Investment Advisory, and he's been in that role for the past 12 years, I think. So Simon is going to bring for us a really kind of interesting topic, bring it to life, not only in terms of historical context and historical perspective, but also as someone who has lived through multiple cycles, multiple economic cycles, including bear markets. So we are looking forward to a fantastic session. And the way in which this session is going to work is Simon is going to spend a little bit of time up front presenting his perspective and views. What we would like to do then is after about 30 minutes, 20-30 minutes, we will open for questions. What I would ask is that if there are questions as we go through, please type them in the chat box. And then what I will do is I will aim to facilitate the conversation once we get to the end. And we hope it's very lively and that we all get to ask everything that we want. Certainly, I'm looking forward to learning a lot and to asking some of my own questions. And so without further ado, I'm going to say thank you to Simon for being here on behalf of all of us. And Simon, over to you. Thank you.
Well, Alison, thank you very much for that kind introduction. Can everybody see me, but more importantly, see the slides that I'm going to go through? Can somebody give me the thumbs up? Yeah, okay, great. So look, welcome, and thank you so much for taking time out of your day to hook into this call. 35 years ago, I was studying at the LSE. So for some, I think certainly for my children, that seems like the dark ages. But I think, in fact, for me, it was a period of enlightenment, and I have, forever had a terrific gratitude for how the LSE was my springboard for, really fascinating career that I've been lucky enough to have. And so today is to talk about some aspects of financial market history, and whatever you do post the LSE, at some point you'll be thinking about investing, whether it's pensions, savings, giving advice to somebody in your family. And to misquote Charles Dickens, I think managing money and the investment business can be the best of jobs and the worst of jobs. It's probably one of those few businesses where you can go from appearing like a hero one year to wholly inadequate and pretty useless the next. Now, I stumbled into this business back in 1985. I had a German flatmate. It was my last year at the LSE. Goldman Sachs were making their first visit to the campus and to be interviewing students. I didn't know much about Goldman Sachs. There was no internet, so one sort of thought one could make it up as we went along. And my German flatmate had told me very assuredly that if he was asked what he wanted to do at Goldman's, he would tell them that he wanted to do portfolio management for high net worth individuals. So I was indeed asked that same question by these very smart Goldman's executives, and I replied with confidence that I wanted to do portfolio management for high net worth individuals. And they answered that there was no such job at Goldman Sachs. Whereupon I said that I was very flexible, and shortly afterwards the interview ended and I did not work at Goldman Sachs, although I then ended up actually spending most of my career at Morgan Stanley. So let's jump in and let's talk about bear markets, but investment markets, generally. And we're going to run through some slides here. And I guess that in my time, I've seen the Japanese bear market, which stands out as the greatest, which from 1989 to its nadir saw a decline of 80%. And I've seen 4 wrenching US bear markets with declines of between 30 and 60%, including the 30% decline this year, which was probably the most rapid fall and recovery on record. And less known, but equally remarkable, back in 97, 98, we had the Asian collapse where currencies like the Korean won fell 50% and the Indonesian rupiah fell 80%. So people talk about bear markets often in terms of equities, but my goodness me, oil, gold, sterling, and we'll look at some of those. Now, forecasting recessions and bear markets is next to being impossible. It's a question, I suppose, why economists don't give forecasts and time periods at the same time. But just to put some historical context, in the US, where the data set allows us to go back a long way, from 1900 to 2015, there were 33 bear markets. Statistically, they occur 1 out of about every 3.5 years and typically last just over a year. And so if we start by looking at some of the data on the second slide, you can see circled in yellow, 74% of years in this period, which is nearly 100 years of data, you've had positive returns and very various, positive returns. But you've obviously had the tail of some very devastating years on the left-hand side. So we know that investing in equities carries, risks. That's no surprise. And some, moving to the next slide, are more pernicious. And people love to talk about 1929 as a combination of deflating an extraordinary bubble and of monetary and fiscal responses that led to this long period of economic decline and wealth destruction. And I guess that if we then start moving more rapidly to a period where some of us were, growing up, the 1970s, you had a period with the S&P 500, that's the Standard & Poor's 500, the largest 500 companies in the US by market capitalization, fell a full 50 or 48, 50%. And remember that these are all nominal numbers. So these don't take into account the effect of inflation. In 2007, 2009, what is now called the Great Financial Crisis, stocks actually fell a full 57%. You'll see I've got this on a log scale to be able to more effectively represent what was going on. And I also now, so we just move away from the US, look at things in terms of the world index. The FTSE, this is the FT World Index that brings together global stock market capitalizations. Again, I've just pointed to the 3 last big ones, minus 50, minus 59, and minus 34. And bear markets inflict the most damage when they coincide with recessions. And there's some data here that I won't expect you to be able to either decipher properly, but when you get the really significant declines, they coincide with the recessions. And bear markets can't be avoided. They're part of the normal rhythm of the markets. And to a certain extent, and we might talk about this later, central banks have chosen to ride to the rescue at a number of crises, which can be argued creates moral hazard, which many of you will be familiar with, whereas in fact, many would argue that a proper clearing and cleansing is required after periods of excess to be able to rebalance, reposition, and start again. Now, one of the most extraordinary things is that you can look at a period, and this happens to be a 20-year period of 97 to 2017, and you could look at a variety of assets. On the left hand, gold happened to give the largest annual return at 7.8%. You can see stocks shortly after. But if you go to the far right-hand side, you'll see that the average investor, this is a US survey, only gained 2%, which of course should have people scratching their heads and saying, why is it possible that they captured barely a quarter of the return? And the answer is that, of course, fear, greed, human emotion come to play very important parts. And typically what that means is people switch between areas that they think are not going to perform, which obviously follows a period when they haven't, to hotter, more desired areas. And you could only need to really go back 8 weeks to know, and you will have all read that the FANGs, the 5 largest stocks in the US, which then made up 25% of the stock market capitalization, the Googles, Alphabets, Microsofts, Amazons, fantastic companies. came to dominate, and investors who had not owned what would be called the growth aspect of the market, but in value, were close to capitulation. And in the business that I'm in, I've seen it. People just saying, I've been buying value stocks, they've done so badly, I finally give up. And of course, sure enough, we've seen a switch, a very marked switch in the last few weeks. But I want to go back just a little bit further. What is quite extraordinary is that stock markets are supposed to be discounting mechanisms, i.e. they essentially are looking ahead of present day events. And this happens to be data from the Financial Times, 1940. You can see this is the UK index, how it collapses because of the German invasion, declaration of war, and yet rather curiously starts to bottom in June, July of 1940, and starts to rise, and rise in a quite a pronounced manner before there was any evidence that the military conflict was moving in favor, of the West. And I'm moving now to the period following that, which is into January of 1941. There was a decline again, and even before there was evidence that Hitler had overreached and that he would struggle with his supply chains and try to fight a war on two fronts, the stock market had been moving up, which really I think is quite extraordinary. There's a very good book called Wealth, War and Wisdom, written by Morgan Stanley's former strategist Barton Biggs, which gives much more evidence on this. So stock markets often can tell us or try to tell us what might be happening ahead. I don't propose to spend a lot of time on interest rates. I gather from the conversation before that Professor Schultz has done some really interesting work on European interest rates dating from the 1400s. This only goes back to the 1790 period, although the Bank of England's done some fascinating sort of equally long-term data. But the trajectory of interest rates over this long period has been broadly down. One thing you'll note is that when the interest rates rise sharply, it's typically in response to inflation, and central bankers don't want to tighten aggressively for long. So the spikes up in rates have been short-lived because there is a natural contraction being sort of forced upon the economies, and then the release has been sort of slower. And so the move from lower rates to higher rates is long drawn out. The move from higher rates to lower rates tends to be much shorter. But of course, it begs the question of what sort of world are we in when we have rates? And here's the Bank of England going back to 1310. How do we explain the current rates that are at levels not seen in any of our lifetimes, and their persistence? And allied to that, this vast debt creation that is leaving, the UK is only one country, levels of debt, that are associated with post-Napoleonic wars, post-Second World War, etc. We might come back to that. So let's look at some, intriguing behaviour. I talked about war, but there's also something that is interesting, is that on fixed income, before I leave that Neil Ferguson, the economic historian, has actually documented that in the months leading up to the First World War, bond prices of the major European governments were extremely stable. So I'm not going to talk about that right now, but again, it's quite interesting how bond markets reacted quite differently to equity markets. But I want to talk about, and I'm sorry, here is a Business Week slide, a large publication in the US. It's dated August 1979, and I suppose that in that is a lesson for being it's the sort of the death trap of the Economist, which often has a headline on its front page, which gets a lot of attention. But beware, this was a well-circulated article telling investors that effectively, the equity markets should be avoided because inflation was destroying the markets. Here on this next slide, you can see how this bear market unfolded. You can see the Business Week article came out here, and it won't surprise you that the blue arrow here on the left is when that article was published, and 20 years later, that was where the index had risen. And there was a very interesting survey done in 1982 where only 5% of the population in the US thought stocks should yield less than bonds. And sure enough, 20 years later, that had been completely inverted. And so clearly there is the madness of crowds. There is the fact that we all get driven by a sense of feeling comfortable by investing with others, but it can be a dangerous, very dangerous place. This was the last year. This was an article from the New York Times. The bull market has no expiration. And of course, within 9 months, we had COVID upon us, and we had great declines. I want to move slightly on to a different topic, which is the Iraq War. Now, you can see on this slide here, and the red dot here is when Iraq invaded Kuwait, and the S&P probably fell nearly 20%. But yet again, it started to bottom, and you can see when Desert Storm, when the response from the West happened, you already had the stock market lifted, and the stock market had regained and gone through its highs by the time the ceasefire was seen in 1991. If I look at the oil price, that's actually perhaps even more interesting. The oil price here bottoms at somewhere, I think, around $8 before ramping up in the face of the worries about oil supply disruption, effectively goes up 4 times. But once again, it becomes evident that disruptions won't be as great as the oil price moves all the way back. So a classic reaction of financial markets, fueled by fear of the unknown. Markets hate, uncertainty, and pricing, in this case, a scenario that didn't pan out, which was significant 1970s style, permanently higher oil prices. So I want to just then move the discussion on to broaden it to this notion of, we have 2 types of bear markets: cyclical versus secular. A cyclical bear market is typically some call them a garden variety, by which they mean it comes with a recession, or at least a sort of downturn in economic activity. It's typically measured as being 20% decline, introduces a cyclical bear market, and it's one of those episodes we talked about earlier. But a secular bear market is different. A secular is a much more drawn out, pernicious, long-lasting affair. So let's look at Japan. Japan emerged from the Second World War, obviously devastated, but found through effective manufacturing and increasingly manufacturing of cars and electronic goods that it stole a greater share of world trade, and its stock market enjoyed the most extraordinary ride. In 1975, as you can see, Japan was 11% of the world index. March on to 1998, 99, it became nearly 43% of the world index. An extraordinary valuation attached to that market. The concept of Japan as being taught in business schools as having the greatest know-how, knowledge, quality circles, allowed Japan to enjoy an extraordinary place. But of course, that was a secular bear market, because the unwinding of that has taken decades. The banking system was kept afloat, and had been at the epicenter of the problem. And the authorities responded, as you'll see in this red line, by slashing interest rates all the way to the bone, to zero. In fact, for years we talked about ZIRP, Z-I-R-P, zero interest rate policy, and the Japanese are really the first to practice it. And I think we looked on in the West and thought very much a Japanese phenomenon, but it wasn't, it hasn't been, because of course here we are, having seen the great financial crisis introduce a series of absolutely unorthodox measures that nobody could have imagined: zero rates, negative real rates actually, and quantitative easing. And then COVID has ushered in another huge response from central bankers. And so you can just see how, and this red line has persisted. Japan has lived in this extraordinary period of essentially close to no rates, very little inflation, and very modest growth relative to its past. But when we think about investing, and the reason I show this chart is the blue line here is the Japanese index. I've rebased it to 100. You can see that the index had this long slide. But of course, as investors, if you'd been told the Japanese index was going to have that appalling bear market, you would probably have made the decision that you just didn't need to be there. I've taken 2 of Japan's winning companies, Toyota Motor and Canon. You can see rebased there that they enjoyed radically different periods of success and profitability, and so there is an adage in investing, which is that it's not a stock market, it's a market of stocks. And as the great stock pickers will tell you, from Buffett onwards, is that one really wants to find those winning companies and try and stay with them if bought at sensible prices and not shaken out. And even though the environment right now economically is very tough, you can already see which companies have prospered and which people have been much more sort of fearful of. Another secular bear market was the NASDAQ. The NASDAQ had a decline after the internet boom of close to 80%, as we had seen extraordinary valuations reached, the justification for valuations that always come at peaks of manias, and the unwind was savage and brutal. And I don't think that most experienced practitioners could ever have believed that NASDAQ would come back as it has come back, and you'll see later on it has gone on to to exceed its former highs. I have a question that I typically ask students, and because this isn't interactive, I don't know, but I think there is a chat function. So I will say this, that I am going to offer a prize to anybody who can answer this question. This is a company in the US that in 1988 had 145,000 employees, 65% market share globally, revenues of 16 billion, had existed since 1880 and had a world-class management, proper accounting, a culture people admired, and was one of the most respected consumer product companies. Well, I can't see the chat lines, but the first person to answer this correctly will be given a prize by myself. So I'm going to move on so you can see which is this company. It's Eastman Kodak. Some of you might already be nodding and thinking of it, which goes to show one of the other great dangers about investing is that we can fall in love with companies. And it's not just Kodak. This is an article from Fortune magazine in 1999 talking about the world's most admired companies. Top of its list for 2 years was General Electric. Here's a share price of General Electric. You'll see where that article was produced. Stock was 50 today. It trades below 10. So one has to be very careful at a stock and company level of being seduced by headlines, and there is no substitute for good forensic accounting, good analysis of the numbers, and a healthy dose of skepticism when you're invested. And we could have a long list from Lucent, General Electric in the UK, Enron, AOL, Lehman Brothers. It's the nature of capitalism and the nature of evolution is that companies that once dominated, Sony, which is back and still alive and well, but the Sony Walkman was the dominant way people listened to music before anyone could have imagined streaming, and we know now what a clunky instrument it is. That was what happened to the NASDAQ. As you can see, the NASDAQ had that correction collapse, in fact, and then has gone on from strength to strength. And of course, the question people are asking in the context of Japan is that with Europe now and the US with interest rates at zero, are we in fact moving into a period where, Japan, the Japanization or the Japanification of the world, is that going to be played out, across the West? But currencies are another important thing. I mentioned in the introduction just how savage a bear market could be in currencies. The red and the blue lines here are the Korean won blue, the Malaysian ringgit red, against the dollar. And I don't think that most investors could believe now the sort of volatility that we've seen. Lots of those Asian currencies got into huge financial problems because they borrowed a lot, had debt levels, they couldn't easily cover them, and the debt was in the wrong currency. And so we saw these huge currency collapses of proportions that were, as I say, were unimaginable. But let's talk about something much closer to home, which is sterling. And everybody will be familiar that today a pound buys you sort of about $1.32. The red line here is one measure of purchasing power parity. There are various measures that are used by banks and financial institutions, and somewhere between 1.4 and 1.6 would be a measure that those people would accept. So when sterling has come way down below that red line, there is in investing a sort of what we would call reversion to the mean. Things get stretched too much in one direction, and they tend to push back by and large. And so sterling having got to the sort of the 118 level post-Brexit, here it is at 132. But of course, that is against the dollar. Now, it's a very different question if I asked you and showed you sterling Swiss franc. I've actually got a second question, so I'm going to give somebody a chance to win a second prize. I'll explain what the prize is later. Sterling Swiss franc, you get 1.2 Swiss francs. But what would you have got in 1967? Also, I'm not going to allow you to get onto Google too quickly. The answer is that it was 12. And it is worth pausing on this chart because sterling would have bought you 12 Swiss francs in 1967 and today it buys you 1.2. And so you could say, well, aren't you contradicting yourself when you say there's a reversion to the mean? Well, you'll see here what happens to purchasing power parity, the red line. It inexorably is driven down as the UK runs higher inflation than Switzerland, continual deficits, and it erodes the value of its currency. So why there have been intermittent rallies, the essential trend. And I think if you sit here today and you scratch your head and say, well, what about the next 20 years? You'd have to ask yourself which country is likely to run the higher inflation and more likely to run bigger deficits. We may discuss that later on, but it is, to me, it's very intriguing. So that's a proper long-term, bear market. So I want to move on really to just talking about some observations of people who have been around for a long time, who made some comments. Neil Ferguson shows that in countries where there is reliable data, stocks have outperformed bonds by a factor of 5 over the 20th century. Of course, it makes you say, well, why would I earn fixed income? Well, in March, April of this year, when stock markets were down anywhere from, depending on where you were looking at, 25 to 50%, and bonds were up anywhere from 5 to 15%, owning no bonds would have seemed a remarkably unwise thing. Secondly, Barton Biggs, I mentioned him earlier, history suggests that the rich are typically too complacent because they cherish the illusion that when things start to go bad, they'll have time to extricate themselves, which is why people diversify. David Swenson from Yale University, he runs the Yale Endowment. He has been a fantastically successful investor of the Yale Endowment. He says in an inflation-prone world, you want to be an owner, not a lender. Now, we haven't been in an inflation-prone world. I think that's the subject of another very interesting conversation, because one of the things that has had people like myself scratch our heads, having learned orthodox economics, is essentially that there is a relationship between the supply of money and ultimately inflation. And we have been living in a world where, at least outside of asset prices, there's been very little inflation. Howard Marks talks about a lack of emotionality as a gift in investing, and therefore, Howard Marks, a lot of very interesting stuff that you can read on him. And of course, the problem that we are drawing from all of these episodes is that we as humans, as investors, get very excited when we make money. We feel a greater sense of self-worth, but that reverses rapidly, and losses bring, as this professor says, sadness, disgust, fear, and regret. I think some other analysis was done that showed people are 5 times more unhappy when they lose money than when they make it. And Warren Buffett, who stood the test of time, cash combined with courage in a time of crisis is priceless. But there is one underlying comment that I will actually at this stage conclude on, which is Jesse Livermore, the lesson I learned early on Wall Street is there's nothing new. Speculation is as old as the hills. Whatever happens in stock markets today has happened again and will happen before, which is why recently Paul Volcker, the legendary Federal Reserve chairman, one of the great financial leaders of the last 70 years, made the pithy and somewhat cynical comment when asked about financial innovation, that the greatest innovation, he said, of the previous 50 years had been the ATM, the cash machine. So I'm just going to simply say that for any of you interested in the financial world, I also run a podcast. It's called the Money Maze Podcast. It's in 80 countries. And we have over 25,000 listeners. On this, we've had some fantastic speakers. I think some have been at the LSE. There's a list of them there, but conversations across the investing spectrum. And we actually have the economic historian Neil Ferguson from tomorrow in a 2-part series talking about the debasement of money. And if any of you are interested, it'd be great if you could listen. But I think at that point, I am going to stop talking because I'm hoping that there may be some questions from the audience, and I know I'm probably running out of your patience as well, since I've been talking for a little while.
Thanks, Simon. There certainly are some questions. I was really kind of intrigued when I looked at the chart you had on Japan. When I left the LSE in 1990, I went, actually thanks to Janet Hunter, I kind of went I went to Tokyo, and I worked in Japan. And of course, at the time, and you can see 1990 was the absolute peak of the Nikkei, and it felt like that. And I do remember that the talk of my peer group at the LSE was that the amount of money I was getting as a salary was something like 3 times what anyone else was getting who was going to jobs in London or anywhere else. And but it was needed because actually it was a very kind of interesting time in Japan when everything was kind of on a high. You can see it came down very quickly after that. But anyway, that notwithstanding, there are some great questions in the chat. And the first one is actually the one that I would have asked myself, and is coming from Peter. I mean, so do you think that we would have had a market crash and a bear market had the central banks and governments not intervened so aggressively this year? And do you think that in 2021 a bear market is coming?
That's a great question. I mean, the central banks have developed a playbook really since LTCM, long-term capital management, went bust in '98 or was going to go bust, and they came to the rescue, and then we had Y2K. And, you know, there's a litany of how central banks have deviated from what you might have perceived to be their role. So to answer Peter's question, the playbook was the great financial crisis. You know, in central banks, they fire hose by cutting rates, you know, creating liquidity. And so they have treated this pandemic essentially as a financial crisis, at least initially, or even more, by the monetary accommodation. And that didn't stop, essentially, the stock market's falling 30%. Now, 30% was the US, the broader indices were down further. But I think you're right that the bear market would probably have gone further, and the economic damage, because what you've had essentially are global income supports in the Western world at the cost of huge government debt. But I think that the markets would have closed. The question is 2021. And you know, I'm a sort of, much to my unfortunate cost, sort of an orthodox sort of, value investor, and I've been scratching my head. And the reality, I suppose, is that 2 things might well happen next year. There's a huge pent-up amount of savings because people in the West have not been able to save, and many have had income support. That's not everybody, I'm conscious of that, but there is money to be spent on shopping, airlines, leisure. So the economies will show recovery next year. I mean, I think that, barring some other exogenous event, that's going to happen. And you can see it's already been reflected in the prices of airline stocks, for example, or cruise companies, etc. So I don't think that there is a bear market coming next year. But you have to say, well, if it's that easy, you print all this money and we have this sort of rebound, well, aren't we off? And I think the worry, and what will cause the next bear market will be the realization that inflation is now an issue that has to be contended with, and interest rates must rise. And of course, all this, essentially, if you're sitting there and you have 0 rate of return, and that's nominal, remember, to subtract inflation, it's a negative rate of return. In some countries, you're being penalized for having your money on deposit, like the Eurozone. But I think as inflation comes back and rates rise, then people have to reconsider that whole asset allocation. So there is a bear market ahead. All I would say, Peter, is that it's easy to talk about bear markets sort of in aggregate. The US is an expensive stock market. The UK, because of Brexit concerns, the composition of the index, oil stocks, banks, etc. UK is not an expensive market. Lots of Asia are not expensive markets. So I think that what you've had is this 20-year dominance of the US stock market, and its market capitalization has grown, as we've looked at, all the way to 65%. I think the relative bear market will be the US.
Thanks. We have another question from Will Hobbs. So, the question is cash flow duration a way to understand the outperformance of growth versus value stocks over the last decade? Would a reversal of real interest rate trends, therefore, be a reasonable trigger for mean reversion here?
Well, that's a very erudite question. So congratulations. I mean, might not be the right man to answer it, but I think that if you look to what happened to the FANGs, the Google Amazons, they were the place that money went to because they were the most insulated from the global slowdown. If you're a retailer, you couldn't open your shop. There might be supply chain issues about the goods that you had, but we've all been zoomed out and we've done all the stuff online, et cetera, et cetera. So I think that that's right. As you get normalization, cost of capital rises, and you get supply chains opening up and you get people buying things again, that do you have to have your portfolio filled with the Amazons and Googles? I think the answer is no. Now, there are another whole range of sub-issues, which are the global regulators now looking at these famous five and saying there's too much power. Number one. Number two, if you look at the tax rate paid by these companies, and I haven't looked at it for 9 months or so, but the last time I looked at the weighted average tax rate, it was sub 10%. Now, governments need to get paid for the debt that's being created, and the normalized tax rates in most countries are anywhere between 22 in the UK and maybe 30 in parts of Europe. So what happens to the multiple when you start putting a higher tax rate on? So I think the answer is, you're right, and that would be my view, is that they become a less attractive place relatively, not that their power or influence is diminishing quickly.
There is another question from Will, which is, to what extent do microeconomic factors explain the Japanese situation and therefore reduce the relevance of comparison with the rest of the world? And I'm not sure what specific micro factors, but I don't know if Will wants to speak up.
Hi, Simon. Sorry, 2 questions. And thank you for your last answer. Very helpful. Look, by microeconomic factors, I guess I'm sort of talking about the idea that people feel that Japanese society has evolved in a much more kind of conservative and risk-averse manner. And so therefore, the creation of the keiretsu sort of as a dominant corporate form was about creating jobs for life and stability. And therefore that lack of kind of the dynamism that has characterized US economic development has some kind of explanation for the slow growth, low inflation, low interest rates that sort of Japan has found itself in.
Yeah, I mean, that's probably somewhere I would really want to go and think about it. I thought, first of all, you were asking whether it was micro factors that led to the bubble, which you aren't, and that was a classic bubble because all this nonsense prevailed and people used to justify Japanese valuations. Japan is an interesting place for all sorts of reasons for why it's managed the COVID process better than many. And there's a guy called Peter Tasker who has a very good podcast out there who talks about everything from eating jobs to shaking hands as part of that culture. I don't think I know the answer. Well, I think that, the problem was, of course, Japan created lots of productive capacity, and that was from cars to air conditioning, and found that the Koreans could do as good a job. And so you had some big macro factors, coming along. So I'm not sure. I think the question that's probably I'm wrestling with is Europe really going to mirror some of that Japanification? I mean, Japan grew through this period, but it grew very slowly. People said deflation, didn't have deflation, had stability. So, I mean, you could argue that maybe at a micro level, that if Japan had opened up its female workforce and been more enlightened, if Japan had encouraged more foreign workers to come in, they could have raised their. So I think those are maybe the micro things we were talking about. Actually, Japan is a prisoner, I think, of its own mindset, and maybe that's exactly your point, which is a really good one.
Thank you. Very helpful.
Thank you. I'm laughing at at the Japan and the women and the Enlightenment, having spent kind of a couple of goes in Japan as a kind of a female executive, and I think there's probably a lot of kind of change that's happening, but a lot to be said kind of there. So kind of great perspective, Simon. Actually, Peter has another question, and it's interesting because this is something that as the board a couple of weeks ago, or actually only last week, we were talking about, and as one of the topics we were thinking about, and is really about inflation and also about the change in work and in workforces. And so I'm going to read the question, Peter, but kind of please obviously kind of feel free to jump in as well. But you know, regarding the inflation point, will changes in work patterns, for example, shorter working weeks, working from home, plus technological advances remove wage pressure, presumably necessary for a meaningful rise in inflationary expectations? What do you think?
So I think that, as I said probably earlier on, many of us have been surprised by the absence of inflation. And, you know, we get obviously a couple of types of inflation. The old inflation that we sort of learned at school and university was too much money chasing too few goods. And I'm intrigued because I went to book a couple of flights the other day and they were really expensive. And then when I looked at where, you know, who was offering the flights, and it was like, wow, they're not flying that London-Geneva route as they used to, because of course capacity has been taken out. Now that's one example. But I'm beginning to pick up more of these. You have the shutdown of anything from mines to airline capacity, that there isn't price coming back in because of the loss, which is why firms like Ryanair and EasyJet actually, you know, think if they can hang in there, they're probably in a really good place because their pricing power has gone up. Now, your question is really on incomes. If you're a retail employee in the West, it must look pretty dire because you haven't got any pricing power. I think that if you are a a specialist oil engineer, notwithstanding what's happened to the oil price, you're a Schlumberger, for example, we talked about ESG. I'm told that there's quite a lot of demand for specialists, engineers, because they haven't been trained and people have not been going there. So I'm not sure is the answer to that. I think that you'll have a very varied picture depending on industry. And, if people start sensing the cost of living, because health insurance, education, transportation, those are three off. If all of those are in your budget and they're going up, the next thing presumably you do is you say to your employer, hang on a second, I need to keep my, my comp up with, at least, in real terms, that's a 3% pay rise. Now, I mean, you, Alison, may be able to inform us from your position at Accenture. There is going to be, inflation. Difficult to absolutely pinpoint its source.
Yeah, thank you. I mean, I think, certainly, I think what we see and probably what I see is kind of more the type of jobs changing, particularly some of what would have been regarded as good administrative jobs in the past. So as you see advances in technology in particular, and how kind of humans and machines are actually coming to work together in different sectors, I actually do think there are lots of areas where not in the next 1 year, but say in the next 5 years, you're going to see some quite dramatic changes. And those areas are not necessarily areas in terms of types of work, so it's more tasks that can be removed. But a lot of it would be things that historically I think would have been regarded as very high paying jobs. So things in some of the services industry, things in places like legal, things in places like audit. I mean, you can find already lots of work that would have been done, particularly by young graduates, maybe kind of 5 or 10 years ago, has already been taken out and can be actually kind of pretty effectively done by machines. And so I do think that there is a kind of a fundamental shift in work and how work will get done, and what people need to be thinking of in terms of the work that they're going to do. But I think that's going to take a bit of time to play through into the economy. And I do think that it's going to be very different in different parts of the world and in different sectors, as you rightly say, Simon. I'm just looking to see, I do have a question of my own. I'm looking to see if there are others before I ask my question, and it looks like we do have a couple of questions. So, well, again, I mean, is the culture difference between the US and UK with regards to appetite to invest, real or imagined? That's a great question.
Just please, Alison, just ask that one more time while I think.
Is the culture difference between the US and the UK with regards to appetite to invest real or imagined?
So I listened, well, I interviewed Sir Xavier Rollet on my podcast a few weeks back, and he answers that question. So I'm going to paraphrase it by saying that Europe's failure to develop deep equity capital markets is the reason that Europe hasn't had a Google. Because they don't understand their addiction to debt, and debt finance is the real problem. It makes a distinction between Europe and the UK, which is the UK is closer to the US than it is to Europe, as we know. And you know, it needs to be very clear in the post-Brexit world that it is open for business and has the institutions and others. And I've been speaking to a variety of people on this subject as you know, about the need to encourage technology innovation, which is part of the issue. And there was I'm going to maybe mispronounce him, Professor Goisberg from Harvard Business School produced a study where amazingly, board directors, when asked their top 20 qualifications, technology and innovation was 17 and 18. And I suspect that that's worse in UK Europe than it is in the US because of the great sort of West Coast industry. So I think that great American can-do attitude, which probably being played out in China to sort of albeit differently, is different from from a lot of what we see in the Europe and parts of the UK. So I think there is a cultural aspect to risk taking, and there is a stigma about failure which is deep-seated and persists.
Thank you. We have a question, and we have Simon who wants to ask the question. So Simon, please.
Yeah, hello. So thank you for your presentation. I found it very engaging. I also went to Clifton College, so I've actually tried to contact you before, but I don't think you picked up the message. I messaged you on LinkedIn. And I'm going to ask a similar question that I've asked you before, and that is, what advice would you give to someone? So I'm first year, also studying economic history. What advice would you give to someone looking to enter the financial services sector?
Okay, well, Simon, having been firmly put in my place by not responding, so thank you for that public humiliation. I will be responding. I also chair the charity for that school, and so yeah, very nice to connect with you. Look, I'm intrigued as I meet more and more people about asking that question, and I think that I'll answer a couple of ways. What are the qualities that I would encourage? I have 3 children between 15 and 22 at university, so it's a conversation that is live. It is a combination of be enthusiastic, do your homework, because as I boringly say, fail to prepare, prepare to fail. I say, and be ready to do whatever you're asked, because you graduate from a great institution, don't have any affectations, you've got to get your sleeves rolled up and you need to do it. So when I've interviewed a lot of people over the years, and I think that a sense of that enthusiasm, a sense of passion, and a sense also of different experiences, turning up in financial services with an interview that reads like a the sort of my interns were at Goldman Sachs and at Morgan Stanley. It's all very good. A lot of people are quite interested in what else you've done. Why did you go and work in the Ecuadorian rainforest? No, it's not because they want to see an ESG angle. I'm not suggesting that. It's because how do you demonstrate that you're going to be the person that they want to sit next to for 8, 10, 12 hours a day when some form of the working life comes back? I could go on about those qualities, but I think that those are sort of some of the key ones that I see, because financial services obviously want to continue to hire people from good places. I think there's a bit of a reappraisal going on as well. I know one financial firm now says it won't take Oxbridge bursts. So it's that classic thing that you need to see, and you want to have people who are clearly smart, but as well as being smart, that they've demonstrated some success. They are, people who are really going to, as I say, be there on the journey with them enthusiastically.
Perfect. Thank you very much for that. Thanks.
Thank you. I just kind of a call out. Is there anyone else would like to speak up and ask a question?
George.
George, we have a hand, a blue hand.
Hi, Simon. Thank you very much for the talk. Just further to the podcast you mentioned with Sir Xavier Rollet, which was highly enjoyable, so thank you for that as well. He spoke rather negatively of European addiction to debt financing. And I saw recently that Rishi Sunak announced the first sort of UK green sovereign bond. And it's widely expected that other European nations will follow with that. Do you think these bonds will have a sort of a further that negative role of debt in Europe? And more generally, what role do you see them playing on bond markets and the economy as a whole?
Well, George, it's this ESG sustainability locomotive, which we haven't spoken about today, and I'm going to be running out of time, but maybe we can do something else on it. And I've seen it firsthand. We had Sir Ronald Cohen on a podcast talk about sustainability, and Sarah Gordon, who's CEO of the Impact Investing Institute. I think you've got two things going on here. You've got a recognition that sustainability is not going away, and that actually it can lower the cost of finance by issuing green bonds. Morgan Stanley did $1 billion offering. The purpose of that was to lower plastic in their whole processes. The treasurer apparently was more happy than anybody because the cost of finance, was lowered. So that is not a question. I just put that, on the side. So this is happening. It's real, and you're going to see issuance from corporates and governments at multiple levels in Europe. I think that Europe's, if you like, its affection or its willingness to think about environmental, social governance issues sooner than the US has been a hallmark of Europe, and will continue to be. We're obviously going to see what happens with the Biden presidency, so there'll probably be some reversal of what happened under the Trump administration. But I think you're just going to see more of that. It's a secular trend. It's not going away. But to answer your question specifically, is that I am not persuaded, as I do, my small amount of business in UK, Europe, that Europe has got some great understanding that it needs to reduce its reliance on debt and increase equity finance. I think that, chances for large-scale change, real supply-side reforms. I mean, in many ways, Thatcherite-style privatization programs that could happen in France with housing and a number of other areas. So I think that the status quo is its own pronounced GDP level, plus all of the other intra-EU tensions are going to make it hard for Europe to tilt to what we see, where there is this fantastic appetite for risk capital to be deployed in the US much more enthusiastically. And interestingly, as an aside, Neil Woodford, famous UK investor, some would say infamous, famous, he launched something called the Patient Capital Trust, which was a fund that's now run by Schroders. The reason that he launched that, he told me, was because he felt that the UK was much less willing to lend to that VC startup sort of, pool of, companies, unlike Silicon Valley. And I don't think you can look across Europe and be persuaded that there are lots of neo-Silicon Valleys coming.
Thank you.
Thanks, George. Thanks. We've got time for one more question. It's a quick one. Do we have one? Okay, maybe I get to ask mine. So here's my very quick question, Simon, which is, if you were starting out again, what is the one thing that you wish someone had told you sooner?
How long have you got, Alison? I think that there are two things that I would wish I'd learned. One of them, actually, as I reflect, is just not be nice to everybody, be super nice to everybody you meet on your journey. And, you know, I've fallen short at times for all sorts of reasons. So that would be, you know, number one. And in theory, it's become easier, but I'm not sure, you know, it has, which is data. Keeping, you know, data. I look back at my records and people that I met along the way and where I put their addresses and, you know, how I kept the files. And it sounds like a stupid thing, but, you know, good data records, number two. And I'm going to add that number three is that I just wish I had read a lot more and I'd read more widely, because there is that sort of normalcy bias that we all suffer from. You tend to read the stuff that reinforces your views. I wish I had just been a little bit more of a voracious reader and read more widely.
Fantastic, and that, you know, fantastic kind of thoughts and advice. So on that note, I want to say on behalf of everybody who's joined, everybody who will listen to the recording, and on behalf of the department and the board, a huge thank you to you for spending time and for sharing historical but also very personal perspective. It has been enlightening, it's been invigorating, and thank you to you, and thank you to everyone who joined for your questions and making the time. Thank you. Have a great day, everybody. Thank you.
Thank you very much.
Thank you.
Bye.
Thank you.
Simon, I'll be in touch. Thank you.
Thank you. Thanks. Bye-bye.